Level 1, the applicant. You are a junior at a state school. Not Wharton, not Columbia. A school where the financial aid office knows your name and the Bloomberg terminal in the library has a waitlist sign on it during finals season. You discovered hedge funds the way most people discover things that will change their lives. By accident. A YouTube video. A podcast during a long drive home. Someone mentioning a number that didn't seem real. You started reading. You couldn't stop. You know the names. Ackman, Einhorn, Simons. You know the strategies. Long-short equity. Global macro. Quantitative arbitrage. You know the fund sizes. You know what a 2 and 20 fee structure means and why it matters. You know all of this, and you have never touched real money in your life. You have $1,800 in a savings account and a Robinhood account with $1,100 split between 6 stocks you picked from a Reddit thread 8 months ago. You apply to everything with an internship program. You apply to banks first because banks have structured programs that recruit from campuses like yours. You get 2 first-round interviews. 1 second round. 0 offers. The recruiter emails you that they're going with another candidate. You find out later that candidate went to Penn. You go back to the lists. Smaller funds, 1-paragraph cold emails that you write and rewrite until they are 7 sentences that say everything important and nothing unnecessary. You send 43 of them. 9 responses, 3 calls. 1 interview. At a fund with 8 people and $400 million under management that most of the industry has never heard of. You prepare for 6 weeks. You build 3 stock pitches from scratch. You read every book on every recommended list you can find. You practice your answers alone in your dorm room with your laptop camera on, watching yourself, correcting yourself, watching again. You walk into the office. You give the pitch. You get the offer. You have no idea what you just said yes to. Level 2, the intern. The fund is smaller than anything you imagined. 8 people, a conference room that fits 6 uncomfortably, a kitchen with a coffee machine held together with a rubber band. The managing partner eats lunch at his desk every single day. You expected Wall Street. You got a 7th floor walk-up in Midtown with mismatched chairs. You are the only intern. There is no intern class to compete against. No social engineering to survive. Just you, the work, and the fact that they are watching everything. They hand you a company to research on your second day. A specialty chemicals firm in the Midwest. You spend 3 days reading everything available and understanding almost none of it. On the 4th day, something shifts. You start to see the structure of the business, the segments, the margin profile, the customer concentration risk nobody seems to be discussing. You build a model. You put the model in front of the analyst. He reads it for 4 minutes. He asks 1 question. Why are you not accounting for the capital expenditure cycle beginning in 2025? You didn't know there was one. He tells you to read the most recent Investor Day transcript. You go back. You find the paragraph. You rebuild the model overnight. The thesis doesn't change, but the numbers do. You come back the next morning. You say, the thesis holds, but free cash flow is compressed for the next 18 months. He nods once. He says, write it up. That nod is the entirety of the feedback you will receive for 3 weeks. At the end of the summer, they offer you a full-time role, not analyst, research associate, 1 step below, but 1 step above leaving without a path. You say yes. You don't negotiate. You don't have leverage. You have a way in. 1 is all you needed. Level 3, the analyst. 14 months as a research associate. You do the work that nobody wants to document, the data cleaning, the model maintenance, the quarterly update memos the analysts use but never credit. You don't complain. Complaining here is not a strategy. Output is the strategy. By the time you move to analyst, you have built models on 11 companies. You know their businesses better than their investor relations teams know their own talking points. Your first official pitch as an analyst is on a healthcare company, specialty pharmaceuticals. One product, strong patent protection, pricing power. 3 months ago, the CEO quietly purchased 400,000 shares of his own stock in the open market. You found this in an SEC filing at 11 p.m. on a Tuesday. You built the thesis that night. You walk into the PM's office with 12 pages of research. He waves the document away. He says, "Talk." You talk for 4 minutes. He asks 5 questions. You answer 4 correctly. On the 5th, about the reimbursement landscape for the drug's therapeutic category, you say you'll follow up within the hour. You follow up in 40 minutes. He puts $18 million into the position. You sit at your desk after the trade confirms, and your heart is moving too fast. Not from excitement, from the specific weight of understanding that you are now responsible for something real. The stock rises 19% over 3 months. He says nothing directly. At the end of the quarter, he gives you a bonus larger than your father's annual salary. You start to understand what this industry actually trades in, not stocks. Information advantages, the discipline to act on them before the market catches up. The problem is that the market is always catching up. Your only job is to stay far enough ahead that the gap never closes while you're inside it. You also start to understand what the job costs. You cancel dinner twice in a week to finish a model. You miss a friend's birthday. You stop keeping track of what you're missing because keeping track makes it worse. The people in your life who aren't in finance have started to understand that your relationship with time is different from theirs. They've mostly stopped trying to change it. That is not something they chose. It is something the job chose for them by choosing you first. You work harder than you have ever worked at anything. And the strange part, the part you couldn't have predicted before you were inside it, is that it doesn't feel like sacrifice. It feels like the opposite of sacrifice. It feels like the first thing you've done that uses all of you. Level 4, the Senior Analyst. 3 years in, you move to a larger fund. 30 people. $3 billion under management. You cover healthcare and consumer. You have a junior analyst and a model builder who report to you. You sit in rooms with CEOs now. Formal meetings, management teams lined up on one side, your team on the other. The CEOs are polished. They've given this presentation 200 times. Your job is to ask the question that hasn't been asked in any of those 200 times. You find it by reading the questions they don't answer. Every earnings transcript has them. An analyst asks about a specific division's margin trajectory, and the CFO pivots to total company margins. That's a tell. You note it. You track it. Over 2 quarters, you build a picture of what the company is concealing and whether the concealment is material. Your first pitch at this fund is on a consumer brand. 6 weeks of work. Thesis in 3 sentences. The PM hears the 3 sentences and says, "Position size?" You say 50 million. He says 35. You take the 35. Over the next year, the position generates $11 million. Not because you were right about the company, because you were right about the timing. You understood when the catalyst would arrive before the market had priced it in. That is the actual skill. Not finding good companies. Everyone can find good companies. Finding the moment when good becomes obvious to everyone else. You are 27 years old. You rent an apartment with a doorman who knows your hours better than you do. He opens the door at 7:10 a.m. every morning and says, "Early one." He says it every day. It stopped feeling early 2 years ago. You stopped correcting him. Level 5, the portfolio manager. They give you capital when you are 31. A $250 million book at a fund that has been trying to keep you for 18 months. You told them you were leaving. They gave you a book instead of losing you. You build the portfolio from a blank sheet. Long 14 positions. Short 6. Net long 60%. You know every name in the book the way you once knew 11 companies at the boutique. But the difference now is that you are the final decision. No one above you in the room when you make the call. The first 6 months, you are up 11%. The market is up 8%. You are generating alpha. The math works. Then November comes. A position sized at 8% of the book, a specialty retailer with strong unit economics, and a management team you trusted, announces an inventory write-down nobody saw coming. The stock falls 22% in one session. 8% of $250 million is $20 million. 22% of that is gone before noon. You read the press release twice. You call investor relations. You call a former employee you know. 2 hours of gathering information that doesn't change what already happened. You hold the remaining position. 6 weeks later, they release updated guidance above consensus. The stock recovers. You exit with a $2.1 million loss instead of $4.4 million. You write the postmortem yourself. You send it to the CIO. You explain what you missed, why you missed it, and how you'd approach it differently. He reads it and says, "Good process." Not good outcome. Because the outcome was not good. The industry is full of people who confuse process with outcome. The ones who confuse them don't last. You check the P&L every morning from your phone before your alarm sounds. You can't stop. You don't know if it's discipline or if it's something else. After a while, you stop trying to tell the difference. Level 6, the survivor. Every PM has a year that defines them. Yours is 2022. The fund is down 17% by September. Your book is down 21%. The macro environment has moved in a direction your models weren't built for. Interest rates are accelerating faster than any historical precedent. The valuation framework that defined a decade of investing is coming apart in real time. You are losing money on positions you've held for 3 years, positions with fundamentals you know better than anyone. The fundamentals haven't changed, the discount rate has. The market is telling you the framework itself is broken. You have 2 choices. Capitulate. Sell everything at the bottom to stop the bleeding. Or hold, because you believe fundamentals eventually reassert themselves. You hold. You trim the most rate-sensitive exposures. You short 3 companies that will benefit from the environment you're now navigating. You hedge differently than you did in January. By December, the book is down 14% for the year. The CIO tells you that 2 of the fund's 5 PMs are leaving. One of them capitulated in September and bought back in at the top in October. He turned a 17% loss into a 29% loss in 60 days. He is gone. You were down 14%. You are still here. The investors who pulled capital during the drawdown will never know what they left. You watch their redemptions process. You feel something you can't name. Not anger, not satisfaction. Something quieter than either. You wake up January 2nd, 2023, and you still have a book. That is the whole story of 2022. Survival is not a narrative. It is a condition, and conditions are what you work with. What 2022 teaches you, what no winning year could ever teach you, is that conviction and correctness are not the same thing. You were convicted. You were eventually correct. In between those 2 points was 7 months, where the market told you daily that you were wrong. You learned how to hold your own judgment while the market screamed against it. That is not a skill you can acquire any other way. It can only be forged inside the loss itself. Level 7, the partner. They make you a partner at 36. No ceremony. A document, a new compensation structure, and an equity stake in the management company itself. You now own a piece of the business, not just a percentage of the performance. The business. There are 4 partners. The other 3 have been partners longer than you. One of them, Global Macro, has been at the fund since before you were born in the industry. He is not threatened by you. He is also not particularly interested in you. That is fine. That is the shape of this. The politics work like this. Capital allocation decisions are made by the investment committee, all 4 partners and the founder. Every 6 months, the founder decides how much capital each strategy receives. Those decisions are influenced by performance, but not only by performance. They are influenced by the founder's read on the environment, which strategies fit it, and who he trusts. You learn to make your case not just through numbers, but through reasoning. The founder does not trust people who only speak in data. Numbers are the evidence. Reasoning is what tells him whether the person managing the capital understands what they're doing, or whether they got lucky and haven't realized it yet. You also learn what you will not do. Some partners shape their positions to match what they think the founder wants to hear. They've been here so long they've learned his patterns, and they perform in alignment with them. It keeps them safe. It has not made them great. You pitch against consensus twice in your first year as partner. You are right once and wrong once. The founder respects you more after both. Level 8, the Chief Investment Officer. The founder names you CIO at 42. He is 67. He has been talking about succession for 3 years and running the fund for more than 2 decades. His stepping back from operational control is not clean. It is layered, partial, and occasionally reversed. You oversee 6 strategies, 11 portfolio managers, and a research team of 22. You allocate capital, set risk limits, and approve the largest positions across every book. You are also the person who tells a PM that his strategy is being wound down because the fund no longer believes in the risk reward. You have done that once. A PM who ran a credit strategy for 4 years. The strategy worked in a specific environment. The environment had changed. He knew before you told him. But knowing doesn't make the conversation easier on either side of the table. You speak at conferences now. Carefully. You have learned exactly how much you can say in public before it becomes something you didn't intend. You crossed the line once, 2 years ago. A passing comment about a sector appeared in a newsletter the next morning, attributed to you as a bullish signal. 3 stocks in the sector moved. A journalist called for comment. You gave none. You now say less in public than you think. That is not a complaint. It is the shape of the level you're at. There is a version of your life that runs parallel to the one you're living. In that version, you are not watching what you say. You are not editing your own thoughts in real time before they leave your mouth. You are not calculating the secondary and tertiary effects of every opinion you hold. You don't know if that version would have made you happier. You know it would have made you less successful. Whether those 2 things are in conflict is a question you've decided not to answer directly. Your daughter is 11. She has learned that when your phone is face up on the dinner table, the evening has a different texture. She has stopped asking why. You tell yourself you will fix that. You have been telling yourself that for 3 years. Level 9, the managing partner. The founder steps back to a chairman role when you are 47. The title is managing partner. It means the fund is yours now. Operationally, strategically, culturally. Whatever this place becomes, it becomes it under your decisions. The fund has $9 billion. That number is not a score. It is a cost structure. $9 billion at a 2% management fee is $180 million in annual revenue before a single trade is placed. That funds the salaries, the technology, the compliance infrastructure, the offices in New York and London and Singapore. If AUM drops by $2 billion, the economics compress immediately. If it drops by $4 billion, you are making hard decisions about headcount. You know this because it happened to funds you watched carefully. A bad year, a wave of redemptions, a spiral that compressed a $12 billion fund to $4 billion in 18 months. The best people saw it coming and left before the spiral completed. Some of them work for you now. You fly to London twice a quarter. Abu Dhabi once a year. A dinner in Geneva in March that involves 3 sovereign wealth funds and a conversation that could move $2 billion in your direction or toward a competitor. You have given this version of yourself to 100 rooms. You know what to say. You know what to leave out. You know how to be the version of yourself that these conversations require. You are not always certain whether that version is still you, or whether it has become you. The distance between those two things has narrowed so much over the years that you've stopped trying to measure it. Managing capital and managing a business are different skills. Most people who are excellent at one are only adequate at the other. You have spent your entire career learning the first one. The second one you are learning in real time, at scale, with everything at stake. The fund's reputation is the one asset that doesn't appear on any balance sheet, and the one asset that matters more than any other. You have watched other funds lose it slowly, through a sequence of small decisions that each seem defensible in isolation. You have committed to not making those decisions. Some days that commitment is easy. Some days something in the business pressure makes the defensible decision look attractive, and you have to remind yourself, quietly, without making a scene of it, why you said you wouldn't go there. Level 10, the founder. You started this 22 years ago, not this fund. Your own fund. The one with your name on the door. You left the firm that trained you. The one that paid you, taught you, made you what you were. You left because you believed you could do it better on your own, and because that belief was the only honest answer you had when you sat with the question long enough. You raised $65 million from 7 investors. 3 were former colleagues. 1 was a family office that had known you for a decade. 2 took a bet on you based on a 60-page document explaining your edge. 1 was a person who simply believed in you in the way that some people believe in people, without a framework, just a certainty. The first year you returned 24%, the second year 16%, the third year you were flat. 3 investors redeemed. You met with each of them. You made your case. None of them stayed. You kept going. Your first analyst hire came from a competing fund. Miserable there, brilliant everywhere else. Your first PM hire was a woman who ran a healthcare book at a larger fund and was being passed over for partnership. She became the best performing strategy in your fund's history. 8 years later, she left to start her own fund. You seeded it. Her first year returning capital as your LP, she returned 31%. You made that call, and you would make it again. The fund is at $14 billion. Your personal net worth exists in so many forms: capital, real estate, private positions, foundation assets, that the number has become abstract in the way that certain kinds of scale become abstract. What you know is that you are no longer thinking about money the way you once thought about money. You are 58. You still read research at 5:30 in the morning. You still argue with your PMs about position sizing. You still sit in investment committee meetings and challenge the consensus when you believe the consensus is wrong. Not because the fund requires it of you, because it is the only thing you have ever done that makes you feel fully and specifically yourself. The markets are the only test you've found that doesn't curve. They don't adjust for effort. They don't reward sincerity. They don't remember who you were 20 years ago. They test you new every single morning. Right now, in a dormitory somewhere, a kid who doesn't go to the right school is writing a cold email to a fund he has no connection to. He has rewritten it 11 times. He will send it and hear nothing. He will send 40 more and hear from 1. He will prepare for 6 weeks for 1 interview at a fund most of the industry has never heard of. He'll walk in. He'll give the pitch. He has no idea this is the moment everything starts. He has no idea what he's walking into.